Good afternoon, everyone. We're just going to wait for a couple more minutes while people log on. Okay, good afternoon, everyone, and welcome to the Calgary Public Library Foundation's Epilogue Society webinar. My name is Alexandra Runge, and I'm the Donor Relations and Legacy Officer here at the Calgary Public Library Foundation. If you don't know about us, we are a registered charity, and our sole purpose is to fundraise in support of Calgary Public Library. And it is thanks to our amazing donor base that we have raised more than $90 million in support of Calgary Public Library since 2013. These funds support the library's innovative and enhanced programs and that really go beyond the core funding. So, for example, last year, donors supported everything from library collections, early learning, and school-aged programming for teenagers, and community programming ranging from Indigenous placemaking, mental health and wellness, support for newcomers, digital equity, and the list goes on. I'd like to begin today's event with a land acknowledgement. It is with gratitude, mutual respect, and reciprocity we acknowledge the ancestral home, culture, and oral teachings of the Treaty 7 signatories, which includes the Siksika Nation, Bagani Nation, the Ghana Nation, the Aithka Stony Nakota Nation, consisting of the Chiniki, Bearspaw, and Good Stony bands, and the people of Tsuut'ina Nation. The city of Calgary is also homeland to the historic Northwest Métis and to the Otipemisiwak Métis government, Métis Nation Battle River Territory, Nose Hill Métis District 5, and Elbow Métis District 6. At Calgary Public Library, we celebrate stories, the stories of the community and the land that we live on. We serve on the community of Winchispa, Gutsitsi, and Mohkinstsis, which describe the gathering places where the Bow and Elbow rivers meet. We respect all people who share, celebrate, and care for the Treaty 7 territory of southern Alberta, and we honor the original caretakers of the land who remind us of the ongoing histories that precede us. We recognize our shared responsibilities going forward to help bring everyone together on this journey of truth and reconciliation. So welcome again, everyone, to today's Epilogue Society webinar. The Epilogue Society series is a showcase of experts and knowledge to help enhance your financial literacy around future planning. At the Library Foundation, our Epilogue Society recognizes donors who have chosen to leave a gift in their will to the library. And these thoughtful commitments create a really meaningful and personal legacy that reflect the values that matter most to these donors. They also ensure lasting support for the library and a stronger community for generations to come. We're so deeply grateful for their support and generosity and are so pleased to continue offering this webinar series on estate and future planning to help you as you explore your own plans with confidence and clarity. To lead our discussion today on gifting and estate top planning tips is Gordon Vanderleek and his colleague Priyanka Brassard. Gordon is the founder and managing lawyer of Vanderleek Law, a Calgary-based law firm that focuses on wills, estates, and trust law. While Gordon's focus is on planning, he is also skilled in the process of dispute resolution regarding estates, guardianship, and trusteeship when the family is not in agreement as to who will be the decision maker for an incapacitated family member. Gordon is adept at making a complex area of estate law simple to understand. He is he has presented at and is a member of such organizations as the Canadian Bar Association, Wills and Trust Section, the Society of Trust and Estate Planners, and the Estate Planning Council of Calgary and Legal Education Society of Alberta. Priyanka joined the Vanderleek Law Team in December of 2024. She maintains a practice in all aspects of estate law, as well as guardianship and trusteeship. She joins the firm from a prominent global law firm, bringing experience in insurance, defense, and management side labor and employment law. We're so looking forward to their presentation. And before I hand things over, I just have a couple housekeeping notes. We are recording this webinar, and you're going to receive a link to the presentation later today, so you can utilize these resources far into the future. And we're going to leave time at the end of the presentation for a Q&A. So if you have questions for Gordon, Priyanka, or for the foundation, please write them in the Q&A box that can be accessed by clicking the chat button at the bottom of your screen. And lastly, we would greatly appreciate you filling out a short webinar survey at the end. This survey will be shared on the screen and will also be in a follow-up email. If you complete this survey in the next week, you're going to have a chance to win a really special prize book package, courtesy of Penguin Random House Canada. And this survey also allows you to let us know how the webinar was for you and help inform our future topics. So without further ado, it's my absolute pleasure to hand things over to Gordon and Priyanka. Thank you for being here.
Thank you, Alexandra. And certainly let's start with our gratitude for having us back to speak on these topics. For the audience, as the introduction suggested, this is our area of focus in terms of a wills and estates law firm. We're concentrated in this area, so we always relish opportunities to talk to people about these important topics. And thank you for all the work in supporting this, advertising it, and providing us the logistics for getting going on this. So you'll see in terms of the slides, and Priyanka and I will sort of go back and forth, but certainly you can have questions for either one of us. And but a couple of, I guess, preliminary points. What we have structured with regard to the presentation, so you can see it on your computers a little better, and we're not into super fine print, and you're squinting your eyes to try to figure this out. We have provided to Alexandra's team the kind of an enhanced version of it, and we've kind of stripped it down to the main points we want to talk about. So you'll hear us talk about various points. And there may be things you go, hey, that's not on the PowerPoint presentation. So don't fear. You don't have to sit there and madly scramble. You will get something afterwards that has a little more detail, some of the things we're talking about. So you'll have that for your records in case you want to reflect on anything that's here, or certainly in our contact information is there. If you say, I need some follow-up, can you clarify a few points? So we're delighted to be part of it. And so you can sit back and listen. There will be the materials, the fulsome materials will follow. And I thought I'll start, I guess, on the slide that's being displayed here in terms of what we're going to cover today. So while there's many things we can talk about in the estate planning field, we thought we wanted to focus on the gifting strategy. And as it relates to your estate plan, what are some tips and traps? What are some things that you need to be mindful of? And so this is drawing on our years of experience and seeing many of these situations, and sometimes it turns contentious. And that's why people have to call a lawyer, because we're called in to try to resolve a matter. And sometimes there's sort of these quick fixes. People say, well, I just do this, and that's going to be a good result. But the context here is certainly looking if you're a parent or a grandparent and you go, I want to gift some things away. It could be gifting money, as you say, to the foundation. It could be to other charities. It could be to your kids. So a lot of times we see issues that people don't do the planning properly. We wanted to alert you in this presentation to the, give you some tips to avoid you falling into those some of those problems, because sometimes while there might be solutions if you go to court or by agreement of parties afterwards, it's usually more expensive, it's delayed, and it's better to do the planning certainly ahead of time. But it's in the context you say, hey, I want to help children, and we'll perhaps use that as the example. But if you're in a grandparent, sometimes you go, hey, I've got grandkids and I'm looking to help them get started, or I want to leave them some money. How does that fit in with my estate plan? So if I say children, or Prank and I say children, you can substitute grandchildren or any other family member that you would want to, benefit from. In some cases, we see that as point number 3 on the slide suggests that you want to help with first home buyers. Let's all just agree that if you're in the Calgary area or another major city within Alberta, life is expensive these days. Property, you look at what property values are, and it's really hard for first-time home buyers to really get into there. So a lot of times parents or grandparents are helping. What are some implications of how you can help? We definitely want to talk about beneficiary designations, because there's some good knowledge you need on that in terms of the implication to your estate plan. What are the tax implications? What are some of the basic tax rules? We're not tax lawyers or tax accountants. But you'll see in terms of the last point, is in some cases, depending on the complexity of your situation, we need to bring in the various professionals who can give advice and to develop a cohesive plan as we're going through, right? So sometimes you need to bring in the tax person to deal with that issue. Lawyers have a role. Sometimes the bankers are involved, or other people, financial advisors, to make sure we get the desired outcome. So with that, that's what we're going to cover today, and I'll turn it over to Pranka to talk a little bit about some of the quick fixes that may be out there.
Thank you for giving us that overview, Gord. I'll start by saying that our intention here is not to dissuade you from engaging in various devices in an effort to transfer wealth to your loved ones. Our role here is to simply alert you to the unintended consequences of improper planning, as Gord mentioned. As you can imagine, in the estate world, we see sort of the range of what can happen, things gone right and wrong. And often we see that in an effort to save costs, individuals will use a variety of quick fixes that ultimately result in an exorbitant cost unintended to the estate and the beneficiaries down the road. And not just financially. When we speak to estate litigation, it'll almost certainly be hard on the family emotionally, and or leading to a breakdown of familial relationships. And so we often advise our clients that our job is to keep your estate out of court through proper planning and legal advice to accomplish your intentions. So the first peril mentioned here is adding a child's name to property or accounts. So there have been many instances where we have seen individuals, more often than not an aging parent, add their adult child's name on title to their home or their bank accounts. This may seem like a good solution to avoid probate or to make things more expedient at the time of death. However, there are a number of issues that can arise from an estate perspective. So first, let's talk about the instance where you have more than one child and only one of your children's names was added to the bank account. Let's say you did your will and you named that child as executor, and so your intention was to ensure that the funds weren't frozen at the time of death, and your executor had access right away prior to obtaining a grant of probate. Well, the question at the time of death becomes, what was your intention? The child, who's the executor, may say that it was a jointly held account. Your intention was to gift it to that one child, and it doesn't form part of the estate, and therefore the other children are not entitled to that account. Because it was a joint account, the bank automatically treated it as though it passed through right of survivorship to the surviving child owner and removed your name off title and released it. The other children will argue that there was a presumption of resulting trust to the estate, meaning the account actually belongs to the estate and should be distributed equally. And there's a landmark decision in Canada released from the Supreme Court in 2007. It's known as the Pecor decision. And I won't bother you too much with the legalese, but essentially what had happened is the court stated that in the absence of proof to the alternative, there was a presumption of a resulting trust for gratuitous transfers, and the onus was on the transferee to show that a gift was intended. Meaning, in this example, the executor child would have to prove that it was a valid gift, which ultimately may result in a costly legal battle for your estate. A second example could be you put your child's name on title for the house. Again, you could run into the same issues I just described with the bank account, but let's say in this instance you only have one child, and so you're not concerned about a dispute between other children at the time of your passing. But down the road, while you're still alive, that child is going through a divorce. Now, because that child's name is on title, the lawyer representing his ex-spouse will try to claim that as part of his assets, thus exposing your house to his matrimonial claim. Or he's involved in a bad gambling debt and creditors are now coming after your property. And that was definitely not your intention at the time you added that kid to title. I had another client last week just tell me about his friend who vacationed down in Arizona with him, and they both had their own properties. And the friend transferred the title to his daughter, and thinking that this will avoid probate fees and all of the issues associated with transferring. And now he doesn't have access to that property because it's being rented out as an Airbnb. And so it's just another example where if you don't document your intentions or do it properly, it can result in a number of unintended consequences. The second bullet here is about do-it-yourself wills and informal documents. And so we've seen in our practice a number of instances where someone will do a handwritten will or use a wills kit online or a letter that looks like a will or some writing on a notepad. That's a true story, by the way, that has almost all of the markings of a will, but isn't quite a will because it missed a key component. What's that anecdote? If it looks like a duck, swims like a duck, and quacks like a duck, then it probably is a duck. Well, that may be the argument used by the beneficiary, but if it's missing the legal requirements as prescribed by Alberta's Wills and Succession Act, we may be left with a problem. I had another file where the parent had done a proper will dividing the estate between both children, but years later decided to do a handwritten note and left it with the prior will with various provisions crossed out saying with the intention to revoke the prior will, or at least that's what we can assume. So this resulted in a dispute between the siblings that could have been avoided with a proper will to replace the old one. It's not to say that the parent couldn't have left out the other child. Perhaps that child was estranged, there was a breakdown in the relationship, and the intention was to leave it to just one. But a conversation with an estate lawyer and properly drafted documents could have saved that estate from litigation. The third bullet here speaks to outdated or missing beneficiary designations. So a common misconception is that the will overrides beneficiary designation forms that may have been completed at the bank or with your insurance provider, which is not at all the case. Beneficiary designations, whether they were done prior to the will or after the fact, will override your will, with a few exceptions that I won't get into in this presentation. Generally speaking, these are separate, and the funds in a financial account or life insurance policy with a beneficiary designation will not form part of your estate. So you can imagine how this will lead to a number of problems, one of them being that if you had listed your spouse as your beneficiary and were subsequently divorced from that spouse and had failed to update your beneficiary designation forms, then upon your death, your ex-spouse would benefit from that account or policy. And this may be even worse if you had remarried and changed your will, but the bulk of your estate was in these accounts or policies. I came across another file where our client's common law partner had passed away prematurely and had never updated beneficiary designations, which listed his parent on everything. Considering this couple had been together for decades, it was likely an oversight on the deceased's part, but it led to a bit of a mess for the surviving partner, particularly because the tax implications for the RRSP payouts fell to the estate and therefore to the partner. The last note here is regarding assuming joint tenancy solves everything. I will let Gordon speak to the tax consequences on the next slide, but as a precursor to that, Adding your child on title to your home can not only result in some of the issues I have already spoken to, but can also lead to various tax implications for your estate, as well as the co-owner of that property. I'll pass it off to you, Gord.
Thanks. Yeah, and I'm thinking of a number of stories of other cases as you gave some very useful examples. All to say that we could spend the next hour talking about war stories and all the different scenarios. But the takeaway would be if you don't do the proper planning, you could have a situation where it's a make work project for the litigation lawyers to sort it out afterwards, right? So we want to avoid that. The message here is let's do the planning. You get to control it in your lifetime, but you got to take that step and do that planning. So this slide, I wanted to focus first and foremost on the generosity. If we take a step back, what we're talking about is a situation where if you're gifting, that means fundamentally your needs are met. I mean, I think that's a fair assumption. It's a rare situation where somebody is impoverishing themselves to the point of not looking after themselves and giving it to children or grandchildren or other family members, right? Usually it's I've got enough, I don't need it all, and I want to gift it because I want to see the enjoyment of that in my lifetime. That's fairly common. Over the years, I've heard that frequently. People go, I'm not going to wait till I'm passed away and then my kids are going to get an inheritance. I'm not there to see it. I want to give it now because I can see that it adds to their quality of life and it's part of our relationship, and I can see them enjoying this, and it's a bit of a leg up for them, right? And I'm going to leave enough for myself. So it's fairly common that people go, if you have wealth and you go, I'm going to be okay, and I can afford to help. I can afford to be generous. I just wanted to put that out there. Is the first analysis is, can you afford it? But let's just say that's an easy answer of yes. So what I wanted to talk a little bit about is just understanding that there are some tax consequences. I mean, arguably, we could go into a whole lot of detail about some of the very specific rules, and that's not the point of the presentation, to get into all the various types of property and what are the tax implications and the very thick Income Tax Act that governs all of that. Suffice it to say is the rules with regard to the tax consequences is you have to look at what it is that you are giving. Right. And then determine, is there a change here and is there a negative tax consequence? And again, to reiterate what we said at the outset, in some cases you go, I may need a tax opinion. I got to go to my tax accountant or a tax lawyer to be able to say, I'm wanting to do this. Is everything going to be okay? Because it kind of may mess up the way that you file your tax returns, or you're going to be offside your reporting obligations. And if you do some search on the internet, sometimes when you talk about gifting strategies, if you're reading articles in the States, they have a gift tax. We don't in Canada, but there can be a deemed disposition if you give away property to someone who is connected with you, somebody who is a close family member, whether it be a spouse or child, in some cases even a grandchild, and then they can extend beyond there. So there's a provision of the Income Tax Act to say if you're giving it, you're just gifting it away. There may be an implication, right, of what you are doing. So you have to look fundamentally at what it is that you're giving, and does that trigger any tax now, even though you haven't received any proceeds? And that is usually the problem, is that somehow you have to come up with some money to pay tax as if you sold it when you haven't sold it because you have gifted it, right? So we just want to be very mindful of that. If you're looking, for example, adding a child onto your property, in Canada, we don't pay a tax on the increase in the value of the places we live. That's called our principal residence, or our home, our primary residence, right? You bought a condo or a house for $300,000 and it went up to $500,000. You don't pay tax on the increase of $200,000 when you sell it because it's where you live. But if that condo or that house was in fact a second property or a third property, right? It's recreational property or it's rental, you're renting it out. Like in that Airbnb example, you're not living there. The principal residence exemption does not apply. So you just want to be really careful of that. And that's some of the tax consequences, for example, of adding a child onto title, is you may lose, when you go to sell it, the principal residence exemption in my example. right? So we've got to be really careful about that and make sure we structure it properly so we mitigate against those risks because it would trigger capital gain, right? If it's in that circumstance, if you're looking at putting a child on an investment portfolio, right? So you have investments beyond your checking account. If you have a savings account that is in fact investments, you've bought stock, and you put that child on, the starting position is there's a disposition. You just gave away half. And if that person is a related party under the definitions in the Income Tax Act, then there's a deemed disposition, or it's deemed to go at fair market value. So if there was some gain because the increase in your portfolio, there may be some tax owing. So you got to be really, really careful because some people start with, I want to avoid probate, which can be a fair objective, but then they inherit a capital gains problem. With that being said, there's not any particular restriction. And again, I'm just going to caution that if you start the internet searching and if you're down in the States, you'll hear some discussions or some people talking about, well, you can only do this much per year. That's based on US rules, and it's not the same in Canada. So fundamentally, you can give away whatever you want. My advice to you would be, don't impoverish yourself to the point that you can't support yourself in later years. It's okay to gift, but there, as a matter of law, there's no restriction on that. But depending on the type of property you are transferring, if it's property that has gone up in value that is not your principal residence or is otherwise capital property, like your stock portfolio, your savings, then in fact, there could be some issues that are there. The final point on this slide that we want to talk about is how you're treating the kids, right? So in an example that Priyanka gave, where one child goes on the bank account or goes on title, but there are 3 children in total, so that the other 2 are going, what the heck just happened here? How come I just effectively got disinherited because I'm not sharing in that bank account or in the equity in the home? So at the end of the day, the starting position from a teaching perspective is there's nothing in the Wills and Succession Act to say that you have to treat the kids equally. Now, commonly, if I'm interviewing 100 couples, they're coming in to do their estate planning, probably 95 of them are saying, no, I want to treat the kids I've always done everything equal. I want to treat the kids equal. That's a common approach to estate planning, but it is not what the Wills and Succession Act says. Right? Leaving aside if you have dependent children, if there's a long-term disability and some obligations you may have to support that child, you're free to do with your money whatever you want. But what we want to emphasize when you're doing this type of planning and the gifting strategy, it could alter what the actual plan is. And Priyanka gave some examples of that. So we want to make sure that we coordinate your testamentary wishes with your gifting strategy during your lifetime. So what that means is if you go, I want to treat all my kids the same, but you're trying to help one child, one solution, let me just give you a practical solution, would be to have your will updated to include a clause that says, well, I've given this kid a little bit of extra money to help for one thing or the other. I just decided I want to do that. Was that part of the inheritance or was that extra? Right. And the problem is because it's family and everything is informal or just kind of understood and maybe not documented real well, that we could get into a situation that maybe children are not dealt with equally, if that was your intention. So really, it comes back to itemizing. The first question I'm going to ask is, well, what do you want as the end result? And then we have to look at these gifting strategies, which are a positive thing to start with. It means, as I said before, that you have the ability to help, but we want to do it carefully. And so for those reasons, you want to really integrate and circle back to the estate plan and ask if anything that I'm doing from a gifting strategy, does it implicate what I have in the will? And it might, right? Depending on what your objectives are as to what happens to your property when you pass away. So there needs to be some coordination with regard to that. And there are some simple solutions. Here's the teaching point. You can't do that after the fact. That's the stuff you have to do in your lifetime. It means you got to update your will to say, oh, I need to insert this particular type of clause and to account for this $50,000 I gave to one kid to help them buy their first home. So there's ways in which we can do that to achieve your desired result of, are we treating the kids the same? but maybe one kid is more. The problem is if there's an absence of your understanding or an absence of documentation of your wishes, it's going to lead to the children fighting. And Pranka gave an example where, there's real life examples and we get involved in files where this happens. So we're not making it up. This stuff happens. And we don't want that for you. We want to keep your case out of court on that. Pranka?
Yeah, so as Gord mentioned, it is not uncommon for parents or grandparents to want to help the next generation with big purchases, such as buying a home. We have assisted clients with this particular transaction in many instances, Gordon maybe more so than myself in his years of practice, but the sentiment still applies that this is something that can be done, but let's just make sure that you, your estate, and your beneficiaries are protected in the process. So let's use the same example. You have 3 children and the oldest is ready to buy a house. You want to gift her $50,000 to contribute to the down payment. The question you'll want to ask yourself is whether your intention is for the $50,000 to be a gift or a loan. The first 2 options that we have listed here, the outright cash gift with a gift letter versus the family loan with a promissory note, covers the 2 examples I just gave. So the first of these options is essentially a pre-inheritance. We can supplement that in the will to include the clause that Gord mentioned, which is colloquially referred to as a hodgepodge clause, in order to equalize what that looks like at the time of death through your estate, so that the extra $50,000 gifted to the one child in your lifetime is equalized relative to the other children who did not benefit from the pre-inheritance. Unless, of course, you decide to gift all 3 $50,000 at that time. And if you are fortunate to do so and there's enough in the estate, then that might be an option you choose. But if not, then this can be one way to sort of work around that situation. The second option speaks to structuring the $50,000 as a loan. A consideration here would be whether you want to charge interest on that loan or set terms as to when you expect those funds to be paid back. In any event, documenting it with the promissory note signed by that child makes it clear what the arrangement was, so that if a dispute arose in the future, this clarifies your intentions. I'll turn it over to Gord for the next 2. Oh, on the last slide.
Sorry.
Yep.
Yes. Recognizing, I thought, previously we had it split between 2 slides. But yeah, with regard to the co-ownership, so a little bit of real estate 101 here. You may be familiar with this. But there's 2 ways in which you could hold title. Let's say, or if you're involved in a real estate transaction that involves a child or a grandchild, you could be as tenants in common if your name's on title, which means you each have an undivided interest in the property. You co-own property. That's common in a situation where couples might buy recreational property together. Let's say Prank and I, with our spouses, would say, let's go buy a property in Invermere, and we want to share that and each have 50%. Well, then for my wife and I, we would be listed at 50%. And Prank and her spouse will be listed as 50%. We're each putting in 50%. So you typically see that as tenants in common. You have a specified interest in the property, right? So if you're giving the 50,000, maybe that translates into a 10% interest. So you say, I want to own 10% of this property. That's one of the options. Or you could hold it as joint tenants. For those participants on this webinar, if you own property with a spouse or partner, in all likelihood, then it'll be as joint tenants. That's what we typically would see, and probably what the real estate lawyer recommended is to say that it automatically transfers to the other owner on the death of the first to go. So joint tenancy equals right of survivorship. It automatically transfers over. Same principles apply, by the way, if you're looking at a bank account, it should automatically pass over. Remember, Prank, you gave an example of that in earlier in the presentation. So here's part of the problem with regard to the owning of the property. Is we focus and we're looking at the estate plan and testamentary wishes, and we want the estate to go very smoothly. But then you sort of run off with the real estate lawyer, and the real estate lawyer has no knowledge of your wishes. What does your will say? What are your testamentary intent? What is the estate plan? And just kind of says, well, let's do this, right? And you go, oh, okay, that sounds reasonable. And then you do it. And is it coordinated? So there's not necessarily a right or wrong. But you want to know the attributes attached to the different ways of holding title. And it's some options available to you. And again, as we said before, you need to get specific advice on what makes sense in your family situation. What are the implications with regard to that? If this is a property where the person is living, it's their home. We use that as an example. Maybe you're only going on title to represent your investment in the property. Well, let's put some documentation together to say that's what it means. Do you want it to pass automatically by right of survivorship, or is that investment in that property come back to your estate and your executor is going to deal with that as part of dealing with the administration of your estate? So some options there, different ways to hold title. You just got to think it through to say what makes sense in your family situation. Lastly, it doesn't happen often, but for completeness of our conversation, I wanted to put something in about trust planning. So you can, in fact, set up a trust in your lifetime, and it could be that the trust would own this property. And it is possible under the Canada Revenue Agency rules to say that property held in a trust can qualify for the principal residence exemption, but there's a myriad of rules and it's very technical area. Definitely need the tax advice, but just on larger contributions, it could be applicable and something you'd want to think about to say, would a trust be appropriate? We don't see it as often, but it is part of the tools in your tool belt in terms of what's available to you in terms of how you're managing things.
So with that, beneficiary designations is another tool that you can use and can definitely work to your benefit, but in some cases your detriment. So let's get into it. The first one, as I mentioned earlier, beneficiary designations on registered accounts and insurance policies flow outside of your estate. Put simply, your will does not control it. So if the beneficiaries in the forms are different than the beneficiaries in your will, you may run into a problem from an estate perspective. The second of these is divorce revokes gifts to a spouse, but it's not the same case for designations. So our legislation covers the issue of divorce and the impact on your will. So if you had done a will with a prior spouse in the past and were subsequently divorced, the Wills and Succession Act revokes those gifts unless you expressly indicated otherwise. That's not the same case for the beneficiary designations. You still have to go in and update those forms. The last one listing here is naming your estate or a minor child directly on those beneficiary designations. So you do have the option of naming your estate as the beneficiary on those forms. The issue with doing this is, let's say between a married couple, everything was structured jointly, the house was joint, all bank accounts were joint, and there was no real need for probate until both spouses passed away because of the right of survivorship on those joint assets. And until we're transferring wealth to the second generation, we don't have to go through the court system. Well, now, if the first spouse's life insurance policy has designated the estate as the beneficiary, let's say it was prior to the marriage and it was never updated, or it didn't designate a beneficiary at all and it defaulted to the estate. Well, now the surviving spouse won't have access to those funds until the estate goes through the probate process. There may also be some tax consequences that fall to the estate and need to be dealt with on the deceased tax return. By the same token, let's say you did your estate planning and created a trust for your minor child in your will until the age of, let's say, 25, with your sister acting as the trustee, but forgot to update your beneficiary designation forms and named the minor child directly on those on the life insurance policy and the other account. And you've passed away while that child is still a minor. Well, now the law defaults to the public trustee being the trustee of those funds until the child is of the age of majority. So your intention was likely that your sister would continue managing those funds for that child. Perhaps your sister was even named as the intended guardian for that child. But because of the simple oversight, now a government representative is holding that money for that child, and not until the age you would have liked those funds to be dispersed, which is 25, if that's what was in your will for the child's trust, but instead a lump sum payout at the age of 18. Gord?
Yeah, so we don't want to try to do a balance here to say beneficiary designations are not all bad, and they can be useful, right? But again, the teaching point, you have to look at the beneficiary designations and figure out what they are, and does that line up with your wishes? One of the benefits of having a direct beneficiary designation would be it's, for example, on RSPs or RIFs, registered retirement income funds, if you're over 71, your RSP turns into a RIF. It will instantly qualify for the spousal rollover. If in fact your estate is doing a distribution, say in a blended family situation between adult children and surviving spouse, now it's like, well, what goes, does the estate have to pay some tax? The will may not have that properly delineated, and therefore a direct beneficiary designation means it's not going to be subject to claims or disputes or tied up in the courts. And it would either, there's no question we're going to get a rollover, which we want to achieve if it goes to a spouse or partner. Somebody who qualifies as that, then there's no tax. So the point is, it can be very helpful for providing that support and avoid claims of creditors or other issues that, if it's a disputed estate. Where they can be really useful if they're kept up to date. Frank gave an example of somebody who, stipulated parents and then didn't make a change. So anytime there's a life event, you want to make sure that you keep it up to date so it reflects your current wishes. And of course, the last point there, we want to coordinate if there's any trust planning that's part of the will. It is possible to say this money is going to this particular person, or it's going to be added to a particular trust, right? We see it sometimes for a disabled beneficiary, and we're going to go, this insurance is extra for that child with a long-term disability. Well, we can do some planning to ensure those proceeds go into that trust. So again, we got to coordinate it. It doesn't happen by default, but it can be a very convenient and useful vehicle for directing funds where you want them to go.
Okay, so I'm just noting the time here. We can continue for a few more minutes and until the Q&A if that works. Okay, perfect. So firstly, in terms of ripple effects, we have largely covered the impact on your will and family fairness. A bit of what we spoke about earlier was just ensuring that we're protecting all the parties involved. If you'd like to gift during your lifetime, let's just make sure we document it properly to avoid potential ripple effects down the line. Similarly, with tax consequences, as Gord mentioned, CRA treats your death as triggering a deemed disposition of your property at fair market value. So sometimes we engage in certain strategies like, let's just sell the home to the kid for $1. Well, CRA won't necessarily see it that way. They're going to calculate it differently, and that's going to trigger a number of tax implications at a different calculation than you might have thought. And lastly, maximizing your charitable legacy. This is something else that can be used as a tool on your final return for a deceased individual. That's known as your terminal return. It's a T1. And through charitable giving, you can benefit your estate considerably in the form of a tax credit, capital gains exemption for donating publicly traded securities directly to charities, or a gift to a charity through your will. Gord?
Yeah, with regard to that, again, the overall strategies, we want to incorporate objectives. And as we started saying that we're focusing on elements of generosity, that's a positive thing, right? And we want to make sure that you're helping the people you want to help with in the most tax efficient manner, but in a manner that doesn't create dissension or conflict within the family members. But we also want to be mindful of creditor protection, and this is where it varies from one client to the next. Maybe you're in a type of occupation or you're running your own business, and there's a strong likelihood there could be lawsuits and protection. And so protecting from claims of creditors to ensure a smooth administration of the estate might be one of the objectives, and we incorporate that in how we are structuring the giving. And certainly you don't want to give money to unintended beneficiaries. So just being mindful of protection for the money that you've worked hard for, and it needs to go where you wanted it to go. And ultimately through this process, we want to achieve peace of mind, right? That's really if a bit of a self-serving comment, because I'm in this business, but I always say to clients, and I genuinely, I believe it to be true, is that yes, we produce documents, but really through the planning process, what we're selling, if you will, or what we can deliver is peace of mind. That they go, okay, there's a good plan, the right people are in place, and we don't have unintended consequence. Put another way, if I'm dealing with an estate where I have to say this is the legal result, right, of what happened. But it's painfully obvious to everybody in the room that that's not what mom and dad intended. Those are difficult conversations and not the way you want to start administering an estate when there's a disconnect between the legal result and what the intended result would be. The goal of working with an estate planner is to eliminate that gap and that the legal result is the intended result. And that's a bit of the theme, I guess, through this particular process. And there are some tools you can use to achieve that, Priyanka.
Yeah, so trusts are a common tool used particularly in high net worth families or in jurisdictions like BC and Ontario, where you're actively trying to avoid probate because there's a lot of costs associated with that. In Alberta, the max you'll ever pay to the government for probate is $525, at least as it stands right now, but that hasn't changed for a long time. That's different in those other jurisdictions, as I mentioned, where probate is sort of a percentage of your estate. And so a couple of the other tools that you can use are power of attorney and personal directives. That forms part of your estate plan. Both documents kick in when you lose capacity and are still alive. So it gives you control as to who's making financial and personal decisions on your behalf in the event that you're incapacitated. And so the way we often put the cost of this into perspective is you might pay $500 to $600 to do an a power of attorney and personal directive, but you can add a zero to that cost if your family is then applying for guardianship and trusteeship, and then another zero if it gets contentious. Guardianship and trusteeship essentially operates the same way that a power of attorney and personal directive do, but it's court ordered in the event that you hadn't done those documents. Life insurance, as we mentioned, is another tool to transfer wealth unencumbered to some degree as it flows outside of your estate directly to the beneficiaries. And the last tool is probate. So probate is not something to be feared. It is essentially the court granting authorization to the executor in order to administer your estate. And so I mentioned the costs in Alberta are a little bit different. It's not a scary thing as one might think. And now with our revamped legal system, there's a digital process for lawyers involved. Probate takes a lot less time than it used to with the paper-based route. And so it's not a big scary thing. Gord?
Yeah. Yeah, very, very true. And some people, again, careful what you read on the internet, because if you start reading about high probate fees and probate avoidance strategies, that might be relevant in the high probate jurisdictions. You always want to look at, well, who's writing that article? Why are they saying that? It may be specific to that province or territory, and the rules are different depending on which, where you're living. So Alberta is different than BC, which is different than Saskatchewan to Ontario and the like. So if we're securing the legacy, I guess as these last couple of slides as we wrap up here, again, a bit self-serving, but I mean, legitimately, I think there's a lot of value in involving professionals in early on in the process. And even for the average estate, this isn't just for something where, oh, if this is for billionaires, do this sort of thing and hire these kind of lawyers. Just the average family, we can sometimes do so much good and solve so many problems with just some basic planning. The difficulty, of course, is getting the people into our office and getting started on the process because it's not a easy process to consider. But I want to emphasize there's a cost of waiting, right? And from that perspective, I think just be mindful of that you can put off something, but then life can give you an unexpected happening, and suddenly you lose that opportunity to do the advanced planning, which is usually where you achieve some of these outcomes with proper planning that you've done things ahead of time. So it's before you get the serious diagnosis. Once you're in the car accident, there's not time to do the planning at that point, right? Or there's anything unexpected. So I think from that perspective, an early conversation can look like we will involve other professionals as part of that. Maybe the accountant, as you've heard, may have to be part of that conversation to determine tax consequences. There'll be, a discussion of what you can afford to give and how do you give it. It may involve your financial planner, and maybe even family conversations. But your professional team is there to help you through the process. And, each situation may involve, if you start coming to typically if you go to a lawyer and say, well, who else needs to be part of this conversation? Then you can outline a communication strategy for that. But I think that gets you to being in control. You get to have your clarity of what your wishes are, and those wishes, the confidence to know those wishes are going to be carried out. And that's really the point of having a professional help it. And again, it's, if you go, I got a modest estate, there's a lot of benefit. And ultimately that will work on the peace of mind that you can achieve knowing everything is in good order, and you're not passing on conflict or dissension or unintended consequences as part of your legacy. But maybe we've got certainly the slide up there, and that will be circulated. So if you want to have some conversations with us directly, we're happy to flesh out any of these situations for your particular circumstances. But maybe we can ask Alexandra or some of her team to
Yeah,
see what questions are in the Q&A, and we're happy to field some of those at this time.
thank you so much, Gordon, Priyanka. I want to dive right into questions because we always get a lot of them. There were so many great pieces of information, and I really loved how just drove home the importance of taking the time to plan. This is something, of course, I think we're all guilty of this. We need to revisit our estate plans throughout our lifetime.
Yes.
And one of the questions that came in here that I'd like to bring forward is how often, do we need to be updating our estates? And in addition to that, at what points do we need to be involving family and the charities that, someone maybe wants to leave in their will? I'll just speak very quickly from the charitable side. I think involving the charity as you're making your plans, the better, because you don't want to, solidify the plan and then inform the charity and discover that maybe where you want to direct your gift is not maybe going to be useful to them years down the road. You want to make sure that, of course, if it's your intention to leave a gift to your favorite charity, that it's going to be useful to them. So involving them in those conversations so that you can discuss what's important to you, what's most helpful for them, I think, or the earlier the better. And I want to just pass over the rest of the question to you, Gordon, Priyanka.
Yeah, so we often tell our clients that a good rule of thumb is every 3 to 5 years, pull it out of the drawer or the safe to just make sure that it still aligns with your intentions. But in addition to that, anytime there's a major life event, someone passes away, there's more kids, there's a house purchase, something like that, it's a good time to just, connect with your estate lawyer and maybe ask that question, hey, should I make changes to my will? Should I revisit this, or is it still okay for right now? Gord?
Yeah, I like that 3 to 5 year horizon, because when you're doing planning, like I just look at it myself, if I'm trying to think, what does the future hold? If I go too far beyond 3 to 5 years, it gets kind of fuzzy. I don't know. Who the heck knows, right? I mean, look at what's happening in the news. There's lots of changes. The tax rules change, family situation changes, finances change. So I think you want to do some planning, obviously more than the immediate moment. So I like 3 to 5 years from a decision-making perspective. But yeah, really to emphasize, you want to look at it more frequently, the better, and then get some advice. And I have it often that people call and say, well, I just did this. I just sold my house. Do I need to change my will? And we had a conversation. The answer happened to be, no, you don't have to. But I appreciated they picked up the phone and called me, and I could give them the advice to say, we're good. Why don't we check in with each other in a couple of years? So I like that time frame. If you haven't looked at it in a while, read it, because number one, if you don't know what it is, you ought to find out what your plan is. And then also, as we've talked about, check your beneficiary designations. Don't make an assumption. Let's drill down and get the facts so we have it all clearly outlined. We can make sure it's a good plan. And that's a good exercise for your executor as well, in addition to having it properly documented. So I would say start with 3 to 5. But, if there's a major life event, then you may have to do it more frequently on that.
Mm-hmm.
And if you're not sure, go to somebody and say, do I need to make a change? right? And get help on answering the question. You don't have to figure it out on your own.
And what do you think about involving family? At what point do you
Mm.
recommend your clients involve their family with the plans? Just so people are not, surprised when the moment comes and maybe the loved one has passed.
Yeah, certainly we see that often. So the general rule of thumb is more communication is better than less, but I'm going to put an asterisk on that because in some family situations, an early communication of wishes actually creates problems, right?
Mm.
With that being said, it's oftentimes better that if you have a very specific plan and you want to design things a certain way, have the tough conversations. I think in general, if you could say, hey, kids, this is how I'm going to divide it up, and here are the reasons. And if they hear it from you, they may not be happy, but that's better than if they're left with their siblings trying to say, well, that's not what mom or dad wanted, and things like that. So I think, generally speaking, if you could take control of the narrative, um, but you got to judge your family's circumstance, that generally leads to better outcomes than if you don't communicate. The other qualifying comment would be it doesn't mean you have to open up and say, well, here's what's in the bank, right? And share all the details, but you can share the high level. Here's how things are going to be divided. If there's a family property and the cabin in Invermere, and you go, well, one child is the one that visits it, the rest of you don't. I'm going to give that cabin to that kid, and that's my wish. I'm just telling you that's what is going to be in the estate plan. Then there are no surprises. Put another way, if there's a missed expectation, that's where people call litigation lawyers and go after the funeral going, this is the plan. What can I do about it? So if they get exactly what they thought they were going to get, that's generally when you go, people are not at that point saying, how can I challenge the will or what are my rights in that situation? Because they're getting what they expected. And mom and dad had a good conversation about it, but it is a tricky one. So in some cases, professional advice on the right communication strategy is important without getting into all the nitty gritty. Do you want to add to that, Priyanka?
Yeah, I mean, the only comment I have is I think it's a change in how it used to be done versus now. Used to be, it was very hush hush. Parents didn't like talking about what was in their will, and then everyone found out at the time of death. Now we're kind of encouraging those conversations that, hey, if there is fighting, let's let it happen while you're alive and everyone's on the same page, as opposed to a costly battle for your estate down the line.
Yeah.
Mm. Yeah, interesting. I think we've got time for maybe a couple quick questions. So one of them here, if I give a gift of cash to my children, would that be taxed? Would they be taxed? Pardon me.
Oh, they be taxed. The answer is no. There's no in your tax return that we all have to file by April 30th, the T1 general return. There's not a line saying, well, what did you receive as a gift? And if you're gifting, in the example the question is posing, am I giving cash? Well, my assumption there is you are giving after-tax dollars. You've already paid your tax. You're up to date. You don't owe CRA anything, right? So if you're just giving cash in the bank, they don't have to report it, and there would be no tax consequence because you're giving cash after tax dollars. The problem comes in when you start giving property or stocks or things that might have a tax implication in some of the things we talked about. So normally speaking, um, there's no restriction on that. The question is, does that make sense with your overall plan? Like, then those are the issues, and some of the cautionary stuff we talked about becomes applicable. But if the question is, do they have to report, oh, I got $50,000 from my mother? No, you don't. You just receive it.
Hmm.
Now,
Thank
of
you.
course, if they take the money and they put it in the bank, it's going to earn income, and they would have to report and pay tax on the growth or the income generated from that investment once it's in their hands with regard to that. But if it's straight, it's after tax dollars, then there's no reporting of that, which again is different than in the States because there's limits on what you could do. So you kind of have to fill it. It is relevant if you are a U.S. citizen filing with the IRS and you got different rules. So that gets back to you got to be careful what you read on the internet.
Hmm. Well, thank you for that point. That's good to clarify. And just one more quick question we've got. Um, so when giving to a charity, is there the option to have my legacy live on forever? So that's a great question. Um, There is an option. We have endowments here at the Library Foundation. So if you're thinking of a legacy gift in will at the foundation, and you want your gift to live on, I would suggest connecting with us, connecting with the team, and discussing how that gift will live on in perpetuity. So an endowment is an investment that generates income over time, and the principal remains intact, and then the interest is drawn off that every year. So I would suggest connecting with me after the webinar and be happy to discuss that further with you. Unfortunately, I have to cut off the chat here, but our information is on this slide. We all welcome, questions. Please get in touch with us. I want to thank you, Gordon Priyanka, so much for sharing your expertise. There's just so much information, and these webinars continue to be so popular at the library and through the foundation, and we really appreciate you sharing your expertise. Um, if you are interested in learning a little bit more about how you can leave a gift in will to the Library Foundation, please feel free to reach out to me as well. And then again, I just want to reiterate that we're going to follow up with this webinar survey. So this is your opportunity to tell us how we did. If you have any ideas that you want to put forward for another webinar, and if you fill in that survey, you do have a chance to win this awesome book prize. So please just take a couple moments to fill it in. And I just want to thank everyone again so much for joining us. And please stay tuned for our next Epilogue Society webinar, which is going to be taking place this spring. Thank you, everyone.
Thank you.
Thank you.